So it's another great time, student, we meet again for this session of advanced financial reporting and analysis. We are going to do a question from the topic of earnings per share. That is, you know that it's under International Accounting Standards 33. So as we have already said that when doing a question of EPS, you need to know how to deal with a question, which has a rights issue, bonus issue, share split, reverse split. So those are the major items you need to check how you are supposed to incorporate them when you are doing your question. So already we have done much of the questions, like around 4 questions, or if not the 3, because we did in our first class. I know we did 2 questions. In our second class we did another question. So this is another question we are going to do today. So for the questions we have done, we have already dealt with the aspect of rights issue, share split, and many other things, like how you are supposed to weigh, how you are supposed to do the basic EPS based on the items provided, like now the one I've mentioned, the rights issue and the share split. So for the question of today, again, we are going to do how to do the earnings per share when there is an aspect of bonus issue and reverse split. Remember that we said that a bonus issue is whereby the entity decides that it's giving shares to the existing shareholders based on a certain proportion at no consideration. That is for free, the bonus. So based on a certain proportion, you are given shares for free, but existing shareholders of the company. So now the shares which were issued through the bonus, you need to know how they are supposed to affect your weighted average number of ordinary shares, how they are supposed to affect your one-offs. Then for the aspect of reverse split, we said that a reverse split is a share consolidation which is done. So the entity will consider that for them to protect the share price of the company, in order to avoid the dilution effect, in order to avoid the dilution of those shares, they do a reverse split. So a reverse split is whereby now they will consider that initially the price of the shares of the entity was a bit higher. So what they do, they would decide to shoot the price a bit higher. So I have said that the company will consider that the price was a bit, not higher, but a bit lower. Sorry for that. So the price of the shares was a bit lower. So for us to avoid dilution effect, for the company to avoid dilution effect of the shares, what they will do is to shoot the price higher. Once now you shoot the price higher, remember that the guys who will be in need of the shares will be few. So not everybody will buy the shares, because obviously we expect that in shareholding, the investors obviously hope that they buy at a lower price and sell at higher price in the coming days. But now if the shares is at a higher price now, not everybody will go for those shares. So meaning that the shares of the company, once we do a reverse split, they cannot be diluted. They cannot be diluted. Anyway, for that purpose, so let's look at a question of November 2015, question 4C. November 2015, question 4C. So November 2015, question 4C, they're saying that Winam Limited, a limited company, has an authorized share capital of 4,000, comprising 600 million ordinary shares of shillings, that is comprising 600 million ordinary shares, each at 5. and 50 million 10% convertible preference shares, each at shillings 20. On 1st January 2013, the company had in issue 160 million ordinary shares and 30 million 10% convertible preference shares. All the preference shares were fully paid, where only 100 million ordinary shares were fully paid. The balance of the shares being 80% paid. The foreign transaction took place in the year ended 31st December 2013, 2014. 2013, 2014. So you are told, number one, the par 3 paid ordinary shares of shillings 5 per value were fully paid on 1st April 2013. Number two, on 1st June 2013, the company issued for consideration 72 million ordinary shares of shillings 5 per value at shillings 8 each in full settlement. The market price of the ordinary shares on this day being shillings 10 per share. Number three, on 1st September 2013, the company issued 48 million ordinary shares of shillings 5 each at fair value of shillings 12 per share in settlement of the purchase consideration on the acquisition of property. On 1st March 2014, the company issued one fully paid bonus share On 1st March 2014, the company issued one fully paid bonus share for every 5 ordinary shares outstanding as at 31st December 2013. Number 5, due to low market price but ordinary shares at the Securities Exchange, the company decided to effect a consolidation of the shares, reverse split, and issued one new ordinary shares of shillings 10 per value for every 2 outstanding and fully paid ordinary shares of shillings 5 per value. This was done on 1st August 2014. Number 6, on 1st October 2014, holders of 10 million 10% convertible preference shares converted these shares into ordinary shares. The preference shares were convertible into 8 fully paid ordinary shares of shillings 5 for every 2 fully paid 10% preference shares of shillings 10 each. An appropriate adjustment for the number of ordinary shares issuable on conversion of preference shares is to be effected for any ordinary share split or consolidation that may be carried out. Preference shareholders are entitled to dividends up to the date of conversion of the shares. The company made a net profit after tax of 225.75 million in the year ended 31st December 2013, and shillings 262.6 in the year ended 31st December 2014. They need basic earnings per share for the 2 years, 2014-2013, and the restated basic earnings per share. So remember that when going through a question of EPS, reading it might not be making sense. It might be stories. You will only start doing something if you start writing down. So you will start doing something if you will start writing down something. So meaning that you know the formulas, to be applied. From that point of writing formulas, you will be able to get marks. So from the formulas going forward. So let's do that question. So I think you have it. You have a hard copy of the same. So November 2015. Question 4C. So November 2015, question 4C. So they need basic earnings per share. So which basic earnings per share, for now it's all about powers of our nose. Profit attributable to ordinary shareholders, you divide with the weighted average number of ordinary shares. So we have 2013. So let's start from powers. So we have 2013, we have 2014. We have 2013, we have 2014. So here you start from the reported profit for the year. So the reported profit for the year. we have the reported profit for the year, reported profit for the year, reported profit for the year. So the reported profit for the year is, according to note 7, the company made a net profit after tax. So remember that this one will be in shillings in millions, shillings in millions, shillings in millions. So that is 225.75. And we have 262.6. So 262.6. So we raise what? We raise the preference dividends. We raise the preference dividends. So, but now, preference dividends, there's something here to consider. Note 6. We have to put into consideration note 6. Because in that note 6, they said, before you and I go to note 6, let me mention something from the start of the question. Remember that Winam Remittance was having an authorized share capital, an authorized share capital of 4,000, made up of what? Made up of 600 ordinary shares. So this 4,000 made up of 600 ordinary shares of shillings 5. And it was made up of 50 million 10% preference shares of 20. So 50 of 20. So that is what is giving us the 4,000, because this is 3,000, this is 1,000. So these are the shares which the company said that the number of shares which the ordinary shareholders can subscribe to is 600. The number of ordinary shares, the number of preference shares is 50. The number of shares the shareholders can purchase, the number of ordinary shares the ordinary shareholders can purchase is this. And for preference shares, we have 50. But during that period provided here, the company issued out of 600. We are told that at the start of the question, the second paragraph, on 1st January 2013, the company issued only 160. So I will be dealing with what they issued. They issued 160 ordinary shares, and the 30 out of this, they issued 30. So what I will be dealing with is 160 and 30. I will start with the 160 and 30. I don't have to talk about the total 650, the authorized. No, but we deal with what is issued. So, meaning that the preference dividends will be paid on ordinary shares or preference. It will be paid on this. It will be paid on the preference shares. So because the preference shareholders are entitled to preference dividends. So at a contractual rate of, we were told the preference share, that is a convert of preference shares, was stated at 10%. It's 10% convert of preference shares. But now I don't have to recognize direct 10% of 30. I don't have to recognize that direct 10% of 30. That is why I'm going to check note 6. That is why I'm going to check note 6. But note 6 will affect 2014. Will affect 2014, not 2013. It will affect 2014 because they said on 1st October 2014, holders of 10 million, 10% convertible preference shares converted these shares into ordinary shares. Avoid the route of disturbance and the noise. So for the preference dividends, remember that we have 2013 and we have 2014. So 31st December 2013, and we have that one of 2014. 2014. So 31st December 2014. So in 2014, they converted 10 million, of which they have said in the last sentence, preference shareholders are entitled to dividends up to the date of a conversion of the shares. So they converted when? 1st October. In 2014, there is a conversion which took place on 1st October 2014. So here we have how many months? Our financial ends December. So these are 9, this is 3. But for this one, it's for 2013 is full year. So when I will be recognizing my dividends now here in the 2 years, in the 2 years, so I have to recognize first the dividends on the convertible, on the convertible security, on the 10. So that one is for 2014. So remember that I would say 10%, which is the contractual rate, times the 10, times, remember that dividends are paid on the value, not number of shares. So we have to multiply with the price per preference. Per preference share, the price was 20. So times 20. So up to the date of conversion, those are 9 months. Those are 9 months. Those are 9 months. So 9 over 12. So this one is for 2014. That is for 2014. So then for the unconvertible, 2013, remember, 2013, we would say 10% times what? Times 30, times shillings 20. Times shillings 20. Then in 2014, the unconvertible was the balance. So 30 minus 10. So 10% times. So this is the total security was 30. In 2014, they converted the 10. So already we have recognized the dividends on the 10 up to the date of conversion. Then the balance we have to recognize. So 30 minus 10 times the price per share, which is all about shillings 20. So what do you have for the first one and the second one, respectively? So if we take 10% of 10 times 20 times 9 over 12. So this is 15. This is 15. Then we have this is 60. Then what about the last one? 0.1 times 20 times 20. So this is 40. So that is how you were supposed to do this. So if there was, again, profit attributable to the NCI, we could have subtracted. We could have subtracted. So this one is 165.75. 262.6 minus 15 minus 40. So this is 207.6. So that is how you could have done the one-offs. The PAUs, not one-offs. We are not yet done the one-offs. So we are under the PAUs. That is how you are supposed to do the PAUs. Now we move to the second part. That is one-offs. That is the one-offs. So for the one-offs, so we start from 2013. Remember that this question doesn't have the aspect of a rights issue or another thing other than bonus and reverse split. That is what we have in the question. We have just two items. We have the aspect of bonus, note 4, that is in 2014, and even the reverse split, that is note 5. Again, the reverse split is in 2014, meaning that in 2013, we just do our one-offs direct. So we say debt details, shares, we weigh them. Once we weigh the shares, we get the one-offs. We get the one-offs. We get the one-offs. So our financial year 2013 starts on January, 1st January 2013. So balance brought down as at the start of the year. The second paragraph at the start of the question, remember that out of the 600 ordinary shares, we said they issued 160. They issued 160. If you continue reading the third paragraph at the start of the question, they say all preference shares or the preference shares were fully paid, while only 100 ordinary shares were fully paid. So the balance is 60. So this is the fully paid for ordinary. The balance being 80% paid. So the balance they have paid up to 80%. So 80% of this is 48. So the part 3 paid. So part 3 paid. We have the part 3 paid. Meaning that what I will do here first, I will recognize them separately. The fully paid and the part 3 paid. The fully paid and part 3 paid. So the fully paid is the 100, and the balance being 80% paid, which is 48. Remember that this is from the start of the year. So meaning that we have to wait for the entire period. So 12 over 12. So you get 100 and then you get 48. So remember that these ordinary shares were stated at a price of, their par value was shillings. The par value of ordinary shares was shillings 5. Or shillings 5. So if you go to additional information number 1, they are saying part 3 paid ordinary shares of shillings 5 per value were fully paid on 1st April. Were fully paid on 1st April 2013. So the balance. So the part 3 paid now fully paid. So again, part 3 paid. So you can say part 3 paid. Now fully paid. So the balance for it to be 160, is it 12? Because by this time you have to have the total of 160. So from April to the end of the year, how many months are those? 9. So meaning that this is 9. Note 2. Additional information number 2. They are saying that on 1st June 2013, the company issued for consideration 72 million ordinary shares of 5 per value at shillings 8 each in full settlement of the market price of the ordinary shares on this day. So the market price of the ordinary shares on this day being 10 per share. So they are saying that they were giving out shares for consideration. So the par value of those shares was 5, but they were giving out at 8. But the market value was the market price of the ordinary shares on this day being 10. They have not been issued at full market price. They have not been issued at full market price. Those shares of 72, which are issued for consideration, they have not been issued at full market price. So this one occurred on 1st June 2013. Issue of shares as consideration. But they were not issued at full market price because these shares of 72, their market price is 10, but they were issued at 8. So we need to equate with 8 to get the shares issued at 8 because their full market price is 10. That is what you are told. But they were issued at 8. So we have to do an equation to get which shares specifically were issued at 8 because these shares of 72, their market price is all about 10. So here I would say 8 times 72 over 10. If we look at the second addition, not the second. If we look at the third additional information, you can be able to notice the difference. Because in the third additional information, they are saying on 1st September, 2013, on 1st September 2013, the company issued 48 million ordinary shares of shillings 5 at fair value. You can see that one is issued at fair value, the new issue. So meaning that for note 3, the 48 million ordinary shares of 5 each, they were issued at full market price. So meaning that I will just recognize them direct. Unlike this one, which was issued at 8, and their market price was at 10. Unlike this one. So what are you getting? 8 times 72 divided by 10. So this is 57.6. So from June, those are 7 months. And this one was from September, October, November, December. This is 4. Are we together? So what do you have there as your answers? 57.6 times 7 over 12. So this is 33.6. And the other one is? So this one was the number of shares, not 12. So we have recorded a wrong number. So this one, the number of shares which were issued at full market price is 48. That is what they said in. That is a mistake I did. So I can see when someone is asking, how do you arrive at 12? So it's 48. So that is a mistake. Sorry for that. So they said, the 3 on 1st September, the company issued 48. So the 12 is the fair value. The 12 is the fair value. So I say that these ones are issued at full market price, the fair value. So that is why I have recognized them direct. Then for this, they were issued at 8, but their full market price was at 10. So we had to go ahead and find the shares specifically issued at 8, not at full market price, as they were stated at full market price, but issued at a lower price. Issued at a lower price. Yeah. So 48 times 4 divided by 12. So this is 16. That is 16. So going to additional information number 5. Additional information number 4. 1st March 2014. For now, we are in 2013. So add this. We are done with 2013. 100 plus 48 plus 9 plus 33.6 plus 16. So this is 206.6. So basic EPS will be, basic EPS 2013 will be 165.75. You divide what? It was 6.6. It was 6.6. So 165.75 divided by answer. So that is 0.8 to 0. Let's say shillings. 0.80 per share. Another thing you need to know that if you will start getting your answers like shillings are 1,000 per share, which company does that? You will be long, obvious. Respond. So, Mary, which response? Which response do you need here? I have responded to you. So these are issued at full market price. That is why I have recognized them directly. The first one, June, they were issued at Aroa price, and their market price was 10. That is why I said the 72. This one. So for this one, it's all about the, remember that from the initial period, out of the 600 ordinary shares, the company issued 160 to the shareholders. But this 160 was not directly fully paid. So they said 100 was first fully paid. We recognized that. The balance being 80% paid. The balance 160 minus 100 is 60. 80% of 60 is 80% of 60 is 48. That is what they said in this question. The balance being 80% paid. So that is the balance. Then in note 1, they said the part repaid ordinary shares of shillings 5 per value. Part repaid. Now what is remaining is 12 for us to make it to total 160. So because already we have recognized the 100 and the 48. Then the balance, the part repaid ordinary shares of shillings 5, that is not 1, were fully paid on 1st April 2013. That is why I went ahead to recognize that 12 on 1st April 2013. Are we together? Yeah. So meaning that we are done with 2013. So let's talk about 2014. Let's talk about 2014. Oh, so that is good. So now that is when I know that you are following. So now I think I was trying to explain about this aspect of the shares for 2014. What I'm supposed to start with here are the shares from the previous year. Are the shares from the previous year. So the shares from the previous year, it's 148, 12, 15.6, and 48. From that first table we did, you add your shares. So by the end of the previous year, the shares issued were 265.6. So the 265.6, there's many students joining rate. So am I at the meeting now and then? Maybe you are asking, why did I not use 12 over 12? When did they pay? Is it 4 months towards the end of the year? Or they were paid on 1st April 2013. How do you weigh shares? From the time they were issued or fully paid, from 1st April to the end of the year, it's 9 months, not 12 over 12. You consider from that time they were fully paid to the end of the year. So that is how we weigh. If it's issue, you consider from the time of issue to the end of the year. So even if yes, they were issued from the initial period, the 148 are the one which were paid from the initial period. That is from the start of the year. The balance was paid on 1st April. So from April to the end of the year, that is how you weigh. Yeah, let's continue. So here we have 265.6. So 265.6, 12 over 12. So we have 265.6. Then we were under note 4, 1st March 2014. So for 1st March 2014, bonus issue. That is what took place. On which proportion? The company issued 1 fully paid bonus for every 5 ordinary shares outstanding as at 31st. The shares which were outstanding as at 31st December 2013. The one which are outstanding as at 31st December 2013 is just the balance brought down. This one. This is what was outstanding from the previous year. So in which proportion? 1 for every 5 times 265.6. So this is 53.12. How do we weigh? Am I supposed to weigh from April or from January? So that one. So for weighing the bonus, we always say that, we always say this. So in case of a bonus, shares and share split, the company receives no additional resources. You know, obvious that bonus, we are giving out shares for free at no price. The company will not be getting anything in return. The company will not be getting in return. It will not be getting anything in return based on the shares it's issuing. So therefore, I33 recommends that the new shares that have been issued in the year should be included in the computation of the basic EPS throughout the financial period. And where relevant, the EPS for the previous financial period should be restated. So it's 12 over 12. It's 12 over 12. 12 over 12. So that is 53.12. Number 5, due to low market price per share at the Securities Exchange, So initially, the price of our ordinary share was at what? The par value from 2013. The shares which were issued of 160. They were trading at shillings. Our par value was 5. So we are considering this to be low. So we are trying to do a reverse to make this price to go high. So due to low market price per ordinary shares at the Securities Exchange, the company decided to effect a consolidation of shares, a reverse split, and issued one new of shillings 10. Now you can see they are doubling the price. One of shillings 10. One of shillings 10 for every 2 outstanding and a fully paid of shillings 5. Of shillings 5. Shillings 5. So remember that that is what they are doing. So far, by this time, the shares we have is, so the total 265.6 plus 53.12. So 256.6 plus 53.12. So the total is 265, not 2. So 265.6 plus 53. So this is 318. So they are saying one new for this. So what about 318.12? So here, this one, the reverse split occurred when? August 2014. So reverse split. So this date again is very important. You remember last time I was saying the share split date is very important. So it's the same way. I could have said 265.6 plus 53.12. Remember that it's just multiplied by a half. What you need to know, the proportion for reverse. The proportion for reverse is a half. The proportion for share split is 2/1. And the difference between share split and reverse split is all about now the dates. You look at that date of a reverse or a split. So going forward for reverse, I will be looking for any security coming now after. Anything which is after the reverse, anything after August, any security which could have issued or converted after August, it means that it does not been reversed. We have to do what? We have to subject it to a reverse. For share split, we were looking at any security issued before. But this one you look after these dates. So this is 159.36. So for weighing, you weigh 12/12, the reverse, because these securities arise from the securities which were incorporated in the capital structure from the start of the year. This one arises from this. So you don't consider from the time of reverse, from the initial period. So 159.36. So you are reverse split. Remember that for the reverse, they are doing a consolidation of the shares. So meaning that your ones will be reduced. Your shares will reduce. So it's a deduction. They are trying to do a consolidation of the shares as the price goes high. The number 6, 1st October 2014, which is after August, meaning that I will reverse these 10 million, which were converted to ordinary. Remember that in that note 6, I'm using this potential security. Remember that the preference shares, they are potential. So we can only use potential securities under basic if they were specifically converted. Of which they said 10 were converted. Remember that the total preference was 30. 10 was converted to ordinary. In which proportion did they mention in note 6? There's a sentence there, sentence number 2 in note 6. They said the preference shares were convertible into 8 fully paid ordinary. 8 fully paid ordinary. That is 8 fully paid ordinary of shillings 5 for every 2. For every 2. For every 2. For every 2. For every 2 preference. Preference. So what about the one they converted? What about 10 preference? So yeah, conversion of, so the conversion of preference. Conversion of preference shares. So 10 times 8 over 2. Then I said we do what? We have to reverse. This is after. They were converted after August. So meaning that they have not been reversed. Their price is low. So 10 times 8, we divide 2. Divide by 2. So this is 20. Then from this one, you consider from this date, October, November, December. So 3 over 12. 3 over 12. So what do you have? So 20 divided by 4. This is 5. Because 3 over 12 is like a quarter. So a quarter of 20 is 5. So give me your answer here. So 265.6 plus 53.12 minus 159.36 plus 5. This is 164.36. So the basic EPS 2014 will be, so 207.6 divide what? 164.36 is equals to 1.26. So shillings 1.26 per share. Per share. So the next thing they need is all about we do. We do what? Restated EPS. So who can explain to the class or to your colleagues? Why do we do restated? Why do we restate? Why do we restate our EPS? Kwa nini tuna restate EPS yetu? Kwa nini tunafanyanga restated EPS? Ukiulizwa hivyo utasema nini? Why? Why do you do restated EPS? So restated EPS 2013. So we would have to incorporate the aspect of bonus and the reverse split in 2013. And once we do the new EPS based on these two being in 2013, we get our relevant EPS, then we compare with that of 2014. Then we conclude about the performance. So the bonus was the first one, but now the bonus and reverse will affect the one-offs, not the profit. So the one-offs 2013 was, the one-offs 2013 was, I expect that you have been making short notes, so give me, so 206.6. So Christine, thank you for that. So 206.6. So let's incorporate these two. So the proportion for bonus. So bonus. Now bonus 2013. So 1 over 5 times this. 206.6. Then I will come and incorporate the aspect of reverse split. So 206.6 divided by 206.6, you divide 5. This is 41.32. And now reverse, we will reverse the total shares as per the time of the bonus. So 206.6 plus now, remember that our ordinary shares have increased because there's a bonus which has been issued. So then we reverse. Our reverse proportion is a half. So 206.6 plus 41.32. You divide 2. 206.6 plus 41.32 divided by 2. So this is 123.96. So obviously it will mean to be 123.96. So remember that for the reverse, I said it's a deduction which is done because it's a share consolidation they do. So meaning that basic EPS, our new basic EPS 2013 will be, the pause was, I can see you always write on the chart there, so you can give me an answer on the chart. So the pause is
165.75.
165 points.
75.
0.75. So divide 123.96. So our new EPS will be
1.34.
1 point into 2 decimal places. 34 per share. So what can you comment about the performance of the company when the bonus and the split are in both years? So remember that in the previous year now we have 1.34. Then in 2014 it was 1.26. So you can say that the company's performance did what? The company performance slightly decreased. Company performance slightly decreased. in the year 2014 compared to 2013. That is from shillings. It's not even it's not a must you mention about those EPSs. So that this is enough. The company performance slightly decreased in the year 2014 compared to year 2013 compared to the year 2013. So, and that marks the end of that question. It marks the end of that question. Any concern, any query? Any question? So it's 10. So we started this class at what time? 9. So we can do one more question. Or I give you assignment, the better. It's a decision. Your end. Christine, you are saying? Christine. How are you? Mute your mic, and that is unmute and speak. So.
Okay, I'm good. I was saying we can do another question. I think so.
Unataka nifanye question solve,
Ya mwisho.
So we can do this question, this question. November 2017. November
Edwin.
2017. Question 4A and the B. Coding,
Hello?
how are you?
I was a bit off when you are trying to do the last part.
So another question is November 2017. So we are going to do question 4 of that relevant city. So question 4B. Question 4B. And for the others to benefit, let me share it to the. So November 2017, question 4. So question 4, November 2017. So question 4B. The following information relates to Sugar Surf Limited for the year ended 31st May 2016. Number 1, net profit for the company for the period attributable to prevalent shareholders and ordinary shareholders of the company was 14.6 million. Information on ordinary shares was as follows. Ordinary shares of shillings 10 each issue as at 1st June 2015. Ordinary shares issued on 1st September 2015 at full price. The average market price of the shares for the year ended 31st May 2016 was 100, and the closing price of the shares as at 1st May 2016 was shillings 110. On 1st January 2016, 300,000 per 3 paid ordinary shares of shillings 10 each were issued. They were issued at 80 per share with 40 payable 1st January 2016 and shillings 40 payable on 1st January 2017. Dividends participation was 50% until fully paid. Number 3, convertible loan stock of shillings 20 million at an interest rate of 5% per annum was issued at par on 1st April 2015. A half year's interest was payable on 30th September and on 31st March each year. Each shillings 1,000 of the loan stock was convertible at the holder's option into 300 ordinary shares at any time. So shillings 5 million of the loan stock was converted into ordinary shares on 1st April 2016, when the market price of the shares was shillings 100 per share. Number 4, shillings 1 million of the convertible preference shares, or shillings 10 each, were issued in the year ended at 1st May 2012. Dividends were to be paid half yearly on 30th November and 31st May at the rate of 6% per annum. The preference shares were convertible into ordinary shares at the option of the preference shareholders on the basis of the 2 ordinary shares for each preference shares issued. Holders of 600,000 ordinary shares, not ordinary preference shares, converted them into ordinary shares on 1st December 2015. Corporate tax rate is 30%. Corporate tax rate is 30%. So we do it. I always say it when reading questions of EPS, you just hear it's like a story. The way Nani was saying, it's like an hot hair. It's until you start doing them. That's when you realize that you are doing something. Even any question of advanced FR, it's obvious wide. Hiyo pepe inakuanga imekunjwa zui mara 5. So ukifungua hivi inakushtua kwanza. So it's until you start doing. So never fear anything. These are the things you have been doing. These are the things you have been doing here and there. So that is why we always say that you practice the area. Then during the exam, you just go to confirm your practice. In an exam, you will not be practicing again. In the exam, you will not be practicing again. It's a confirmation you are going to do. And try to apply all of the techniques from time to time. And the best thing for EPS right now, see, right now here they need a basic earnings per share. Basic earnings per share. For so Mary, you are saying that you always panic. Always avoid panicking in an exam. Hakuna exam inakuanga ngumu. That is why unapatanga students. See, you have the 3 hours. The last 1 hour, it's when you have more content to write, other than the first 2 hours. So start with the same strength you could have used toward the end. Where is this information coming from at the end, not from the start? Once you are well prepared, you will start with the same strength. Then you will find yourself that you are done within 2 hours and a half. Or let's say exactly 3 hours, you will have done at least for you to pass in an AFR exam. At least you have to do 4 questions. 4. This is something confirmed. Yeah? Even myself, when I was a student, you would find that I was doing 4 questions. So once I do 4, then obvious. Once I've done well, I will pass. So if you do 2, you are sure. Then the others is just an addition. That is why I always say that once you are doing AFR is very easy to pass, because some topics, they must appear in your paper. It's a must. Like cash flow is a must. Group is a must. Like now this sitting, we know that EPS will be there. No, you have 3 questions. You know that they will be there. Why can't you specialize on those topics? Hmm? Anyway. So powers divide one-nos. And you might go to an exam, you find that one of the questions we have done here, it's in that exam. So, and without a lot of stories, let's continue. Powers of our nose, we finish, we do other things. So powers of our nose. So let's get powers. So for powers, we start from the reported profit for the year. Reported profit for the year. Reported profit for the year, I said, is all about the profit before after tax. Hiyo ndio kitu ingine students hujichanganya. Before after. So it's after tax. So in addition to information number 1, they are saying the net profit for the period attributable to preference shareholders and ordinary shareholders of the company was shillings 14.6 million. So million 14.6. So yeah, we say shillings in millions. Shillings in millions. So 14.6. 14.6. Then we have to look for the preference dividends to minus here. So dividends to preference shareholders, dividends to preference, dividends to preference shareholders, or we just write preference dividends. It's just the same. So it's just the same. So preference dividends. So check where we have a preference shareholders, the preference shares in this question. That is according to note 4. 1 million of the converter of preference shares of shillings 10 each were issued in the year ended 31st May 2012. Dividends were to be paid half yearly, 30th November and 31st May, at the rate of 6% per annum. The preference shareholders were convertible, so they converted that. So what do we have to do here? So remember that they said the preference shares were convertible into ordinary shares at the option of the preference shareholders on the basis of 2 ordinary shares for each preference shares issued. Holders of 600,000. The preference shares converted them into ordinary shares. So we can decide to recognize dividends on the converted preference shares, then we recognize on the balance. So I can do these in 2 different ways. So first, I can recognize the dividends on the convertible security, because out of the 1 million, 600,000, which is 0.6, 600,000, which is the 0.6, was done what? Converted. So remember that our financial year runs from, so our financial year ends on 31st May 2016, meaning that it runs from 1st June 2015. 2015. So 2015. So here they have said, but they have said that they pay what? Dividends are paid. That is according to note 4. Dividends were paid a half yearly. So meaning that 30th November and 31st May. 30th November and 31st May. A half yearly. They are paid a half yearly. But they converted the 600. That is what they said. The preference shares were converted into ordinary shares at the option of the preference shareholders on the basis of 2. So holders of 600 1,000 preference shares converted them. So what we do here is this. So I will recognize on the dividends on the convertible security, which is 0.6. But now remember that it's on the contractual rate. The contractual rate, these preference shares were stated at what? The security was 6%. They said once they were paying these dividends half yearly, they were paying at 6% per annum. So meaning, so I would say 6% times, they converted these times what? Remember that 0.6, it's in shillings, which is okay. I don't have to multiply with the price. But half yearly, so this is 6/12. This is 6/12. 6/12. Then the unconverted is now, for it to be 1 million, the balance is 0.4. The balance is 0.4. So 6% of 0.4 times what? Times 12/12. Remember that? When did they convert? When did they convert? When did they convert this 0.6? It's first December 2015, which is just the same as this date. Because that November, December, so there's no difference. Meaning that we have considered the 0.6 up to the time of conversion, then the 0.4 for the full period. By the end of the year, that is why they said they were paying dividends a half yearly. So the first one up to the date of conversion, by 1st December, when they converted, then the balance at the end of the year, which is 31st May. Which is 31st May. That is why I've said 12/12. Or you could have even also done this way. You could have said again 6% times what? The 1 million times 6/12. Then that is before conversion. Then after conversion, you say 6% times 0.4 times 6/12. But this one doesn't make a lot of sense. So I always consider this one making sense. So you always use this. So it's more understandable. So if where's my calculator now? Give me the answers because I'm trying to look for my calculator here. Anyway, I have it 0.06 times 0.6 times 6/12. So 0.018. Then the other one. This is 0. The other one is 0.024. So if you deduct, If there was, remember that profit attributable to NCI, we deduct. So never forget about this. Profit attributable to NCI. Remember that you always deduct that, but it was not there. So 14.6 minus 0.018 minus 0.024. So this is 14.558. 14 point that. One knows. In this question, we don't have the aspect of rights issue. We don't have the aspect of anyway, rights issue is the one which obvious. We expect that we use a formula. But for the others, it's all about understanding how you weigh. So you will excuse me for 2 minutes. I take a certain call. So meaning that here we say date, details. So Mary, you are saying you are roast where? Remember that it's something direct here. Up to the time of conversion, then the balance for the entire year, symbol like that. So date details, shares, date details, shares. Wait, and you have one else. So here, our financial year starts on, remember that it was not starting January because it ends May. It starts on 1st April. So the balance brought down. So as at the start of the year, you are told, note 2, information on ordinary shares was as follows. Ordinary shares of shillings 10 each issued as at 1st June 2015. So this one was not April, but remember it's June, so we have done a mistake there. When our financial year ends on May, see, it starts on June. That one, you know, it starts on June. So this one was 2016, so it starts on 2015. So June. That is why at the start of the question, in note 2, you are told that 1st June 2015, the number of shares to recognize there is, because the value is 6 million, per share was at 10. 6 divided by 10, because we need the number of ordinary shares. We always use the number of ordinary shares. So that is 0.6, because the value of is 10. So per share is, the value is 6, per share is 10. So the number of ordinary shares is 0.6. We go with millions. Everything is in millions. Remember that. So you wait for the entire period. So here we have 0.6. 0.6. Then the next additional information now is where we have a lot of stories. Not even before we go to that additional information, still in note 2, there was other ordinary shares issued on 1st September. September 2015. The number of ordinary shares are, the number of ordinary shares, remember they were issued at a full price. The full price is the price from the initial period, that price from the start of the year. The shares from the start of the year was 0.6, each going at shillings 10. That is why we have 6 million. So this price from the start of the year, from June, that is our full price. Meaning that if you take the new issue, so 1.2 divided by 10, what do you have as the number? 0.12. So from September to the end of the year, September to May, September, October, November, December. September, October, November, December. Then plus 5, 4 plus 5, 9. From September to 31st May. So if you divide that, you get 0.09. This one goes with this. So the next additional information now, and that is where we have stories. And you needed to understand those stories well. So in short, this question was not a joke. You can see that. And I realized even in those academic courses during the online tuitions during the COVID-19. So questions of this kind for various courses, they were uplifting from CPA. They test. even in the master's level. Like now, I remember doing this question in a master's program for someone. So they always approved these, they were approving some of these questions. They test at that level. But I think you are understanding what we are doing. So that information in note 2, the average market price of the share for the end at 1st May 2016 was 100. So you need to understand that well. You need to understand this well. The average market price of share for the end at 31st May 2016 was 100. The closing price of the share on that 1st May was 110. The closing price is 110, but the fair value is 100. Then you are told on 1st January, so it's better I draw this number in here because it's very important for that information. So we continue reading. On 1st January 2016, 300,000 Part 3 paid ordinary shares of shillings 10 were issued on January.
Madam, sorry for interruption. Kindly repeat from the new issue.
See, new issue, remember that see the value is 1.2 million in shillings. This one was at full price. See, what we recognize here is shares, which is our full price. Remember that this is in shillings and we need shares. Our full price is that price we recognize the shares with from the initial period, from the start of the year. And from the start of the year, see, it's just that information provided there that ordinary shares of shillings 10 each issued as at 1st June 2015. The price was, from the initial period, it was 10. So that is our full price. So to get the number of shares, we take 1.2 divided by 10. Remember that we need the number of shares to weigh. We don't weigh the value. Are we together, Judy? Then when you weigh, you consider from September. So September to the end of the year. From September to May. So you weigh from that period. From that time of issue. So from September to the end of the year. See, it's 9 months. September, October, November, December. January, February, March, April, May. 9.
Mwalimu, a quick one also. In the question, it's only indicated million and not shillings million. So is that an error or like in numbers shares?
But there's no error there. So meaning that so millions. So this is in shillings. This is in shillings because already they have indicated they don't have to. It's the same way in a statement of financial position. See, always they indicate up there shillings. So they always say they can say the value is in millions. So when they give you the figures down here, so you always say that they are in shillings or they are in what. So I always consider this to be in shillings because already in note 1, they said that each was going at 10. So they cannot be giving you the price. And again, they just give you the number of shares.
So example, if you go to the earlier question, I think it's question 3, not 3. You'll see it's indicated shillings million, property, plant and equipment. So I don't know, but it's okay.
I'll consider this one to be in shillings million. So
okay, thanks.
It's okay. So they were saying that in that information down on 1st January 2016, 300,000 Part 3 paid ordinary shares of 10 each were issued. They were issued at 80 per share. So, but we know that the market price was 100. They have been issued at 80. So there's a bonus element of 20. Were they fully, was the 80 fully paid immediately? No, they said they were issued at 80 with 40 payable in January 2016, 40 you go paid up, and the 40 payable January 2017, meaning that outside this year, January 2017. So how do we recognize this? So how do we recognize this? So for us to recognize this one, we have to recognize them in 3 different ways, 3 or 2, in 2 different ways, because we have the bonus element of 20. And this 40, which was paid in January 2016, because the balance of 40 was paid in the next year. So we don't have to record that for 2017. So this happened on 1st January 2016. That is when the 300,000 ordinary shares were issued. So 300,000. So 300,000, if we reduce to 1 million, it would be 0.3. It would be 0.3. So 0.3 is equals to shillings 100, which is the market price, which is the fair value. So what about the price of 20? The bonus element. So here we say, so the new issue would be 20 times 0.3 over 100. So 20 times 0.3, you divide 100. So that is 0.06. So from January to the end of the year, remember our financial year ends May, 5/12, times 5/12. So 0.025. 0.025. Then after that, so we have recognized the 20, the bonus element. Then now we recognize the 40, which was paid again on 1st January, 2016. So what we have recognized here is the bonus element. So now again, see, they said 80, but 40 was paid on this time. That is what they said in the question. They were issued at 80 with 40 payable 1st January 2016 and 40 payable on 1st January 2017. Dividend participation was 50% until fully paid. So again, it was new issue. So the part 3 paid. Part 3 paid. So again, we say, remember that now here, we are saying that, remember that the price was 80. So now we equate 80 is equal to 0.3. So 40 has been paid now by this time. Then the balance was paid the next year. So here I would say 40 times 0.3. It's like 40 over 80 times 0.3. It's the same way I could have said 20 over 100 times 0.3. So 40 divided by 80 times 0.3. So I get 0.15. So 5/12. So 0.0625. Remember the other 40, we don't have to recognize this year. It was paid in the next year. Then we go to additional information number what? 3. Convertible loan stock.
Mwalimu, before we get to additional information number 3, a clarification and the new issue, the first new issue, because you mentioned that there was a bonus issue. So I was talking like the wait period, maybe 12.
Sorry?
Where we mentioned that the market price was 100, and then the share was issued at 80 shillings. So there was like a 20 shilling bonus.
A reduction in price, eh? Yeah, so I know you are talking about
So-
this one.
No, the first one.
So your question
like,
is?
I think it is a bonus issue. Is it a bonus issue? And if so, we should weigh it at 12/12 for being
That is why I'm saying
getting-
you are asking about this. The one I always going to weigh at 12/12 would be the one specifically when they say that this one is the bonus which was issued at this proportion based on these shares. So this one is just a price reduction. So I'm just using the one, the bonus element was present. So we don't have to apply the same weight as the one when they specifically mentioned that the bonus was issued. So you will only do that when they specifically mentioned that they did a bonus at this proportion on this period. I'm just using the one bonus because it's a reduction in price. It's a reduction in price. So, Jen. So, Jen, I will only do that when they specifically mention about those aspects of proportions and so on. So here it's only that I'm using the word bonus. These are bonus element. There's a bonus element in that shares which were issued. So, so then the other things, the only thing which was difficult in this question by the way is this. These two. The other things are just the things you have been doing from time to time. Because note 3 and note 4 is just the things you know. Because they said convertible loan stock of 20 at an interest rate of 5% per annum were issued. Lost on new issue. New issue, which one? So what I've done is all about the first thing in short, what I've done is that the market value was 80. They issued that. The market value was 100. They issued at 80. So I have recognized the shares based on the price of 20, the bonus element. That is why I said that 0.3 we equate at 100. What about the price of 20? Then I came again to mention about the 80. So the 80 of which 40 was paid this year. The balance was paid next year. So I have said 0.3 is equals to 100. What about the 40 which was paid in this year? That is done. So the balance of 40 we don't have to recognize this year because it was paid next year. Then for the months, it's just from January to the end of the year, which is January to May, 5 months. So next is all about number 3, convertible loan stock. Did they convert? They converted out of the 20 million, they converted 5 million of the loan stock on 1st April. So you can read that additional information number 3. You can see that out of the 20 million, there are sentences there. They said that they converted the 5 million. In which proportion? So remember that we only use the convertible securities if they are converted. So convertible, conversion of loan to ordinary, they converted. So they were converting in which proportion? Each 1,000 of the loan was convertible at the old last option into 300 ordinary shares. So 1,000 into 300 ordinary shares. So they converted shillings 5 million. So they converted 5. So they converted 5 is supposed to be here or here. So this is the loan. So 5. So 5 times 300 over 1,000. That is how they converted that security to ordinary shares. That is how they converted that security into ordinary shares. So what do you have? 5 times 300. Divided by 1,000. That is 1.5. So from April to the end of the year, April, May, 2. Is that 2 months? So if you take times 2 over 12, 0.25. 0.25. Then even in the last additional information number 4, shillings 1 million of the convertible preference shares. Did they convert? Out of the 1 million, they converted? They converted 0.6. In which proportion were they converting? The preference shares were convertible into ordinary shares at the option of the preference shares on the basis of 2 ordinary. They say that the preference shareholders were convertible into ordinary shares at the option of preference shareholders on the basis of 2 ordinary for each. 2 ordinary for each preference shares issued. For each, that is 1 share. That is preference. But remember, this is in shillings. This is in shillings. So do I have to say 0.6 here? I have to reverse these two shares because this proportion is 2 ordinary for each preference. So meaning that you say 0.6 divided by what? The 1 million convertible preference shares was at 10 each. So that so that it will be the same as the proportion. So 0.6 divided by 10. So that is 0.06. So 0.06. What about that? So this conversion occurred when? 1st December 2015. 1st December 2015. So 1st December 2015, they did a conversion again. Conversion of preference now. So 0.06 times 2 over 1. So if you multiply 2, you get 0.12. 0.12. So January, this is January or December? This one is December. So 1st December, it was 1st December. So from 1st December to May, 6/12. Those are 6 months, 6 months, 6 months. So so that is divided by 2. So you get 0.06. 0.06. So you add give me the answer here. 0.6 plus 0.09 plus 0.025 plus 0.0625 plus 0.25 plus 0.06. So you get 1.0875. So now you can be able to get your basic EPS. Basic EPS would be 14.558. You divide by with what? 1.0875, which is equals to shillings. So 14.558 divided by answer. So shillings 13.37 per share. So the examiner again was in need of diluted EPS. The examiner was in need of diluted EPS. So we use the convertible securities. They are just 2. Or we have stock options. So we have to check. Because the one I can see there in the question is convertible loan and convertible preference. Those are the ones we use in computing the diluted. So diluted EPS is a reduction in value of the basic EPS. So we need to check the potential of this, security, the convertible securities they have in diluting this 13.34. Which potential does they have in diluting the 13.34? So I said the steps, you know them. The first step being, step number 1 being which step? You compute basic EPS. Step 2, you determine the order of ranking the securities. So you rank the securities based on their potential of diluting the basic EPS. So you rank from the security which has a lower potential of diluting the basic EPS then to the one which has a higher potential. And once you know their potential, you compute the diluted EPS based on that potential, based on the ranks. So we determine the order of ranking the security. That is where we start from, because already we have the basic. Determine order of ranking the securities. Determine the order of ranking the securities. Right. So remember that here we will be using the potential securities. So we have incremental earnings. Incremental earnings. We talk about incremental shares. Whenever the earnings per incremental shares, this and this is divided, you get this. Then we rank. So the first potential securities, that is according to note 3, convertible loan stock. convertible loan stock. So the convertible loan stock, was it converted? Yes. So if it's converted, first we recognize the interest which you were to pay up to the time of conversion, then we recognize the balance. So meaning that the security, the loan stock was 20, of which 5 was converted. By which time? April. It was April. 5 million of the loan stock was converted into ordinary on April. So from the start of the year up to 1st April, how many months are those? 10. Those are 10 months, 10. So meaning that you say, so 5% of the 5. Remember that the 5 is in shillings, so we don't have to multiply with any price. Up to the time of conversion, 10 over 12. So yeah, we have to multiply with 0.7. I said for the interest, it has to be net of tax, 1 minus T. 1 minus tax, 1 minus tax. That is why in the last additional information, note 5, you are told the corporate tax rate is 30%. Then you add what? The 5% of the balance, 15. So this one will be 12 over 12 times 0.7. So that is earnings. For shares, we already know how they were converting. We don't have to do a lot of things now. So we say 5 times 300 over 1,000. Up to the time of conversion, 10 over 12. Plus the balance, 15 times 300 times 1,000 times 12 over 12. Remember that for the one, even if they never converted, we go with the assumptions. What if they converted? I have been singing this from time to time. 0.05 times 5 times 10 over 12 times 0.7 plus 0.05 times 15 times 0.7. So the first one you are getting what? The first one, guys, I'm getting 0.67. So for this one, so this one is 1500 divided by 1,000 times 10 over 12. So this is 1.25 plus what? 15 times 300 divided by 1,000. So 4.5 plus 1.25. So that is 5.75. So if you divide 0.67, divide 5.75. 0.67 divided by answer 0.12. So the next potential security is concerning the last additional information. The second last additional information, sorry, the convertible preference. So here for the earnings, you know that out of the 1 million, they did what? They converted 0.6. Out of the 1 million, they converted the 0.6. They converted the 0.6. So meaning that it was as the dividends were supposed to be paid at 6%. So we recognize first dividends which were to be paid on the security, which is done what? Converted. And that one will be the 0.6 up to the date of conversion. So we know it's on 1st December. From the start of the year up to December, 6 months. Remember that our financial year ends on May, so it starts on April. So from April to 1st December, 6/12. So after mentioning that, then here we don't have to apply anything concerning 0.7 because the return from preference shares is dividend, so they don't have to be net of tax. Where we apply net of tax is where the return was interest. So this one I can even add here direct because the balance is 0.4. So 6% times 0.4. You know that it's 12 out of 12. It's not a must, I mentioned that for the balance. For the balance here, it's times 12/12. 12/12 is like 1. So yeah, I'm getting, what are you getting? On my side, I'm getting 0.042. Then this was earnings for shares. They were converting this way. So we know the proportion we had already analyzed. And this one we changed it to shares so that it looks the same as the proportion. So the proportion was in terms of shares. So we say 0.06 times 2/1 up to the date of conversion plus the balance 0.04 times 2/1. So remember, this is 12/12. The unconverted. Give me the answer. (0.06 times 2 times 6/12). The first one is 0.06 plus 0.04 times 2, 0.14. So 0.14. So if you divide this and this, 0.042, you divide 0.14, 0.042, divide by answer, 0.3. So now, if you rank, which is the first one, which has a least potential in diluting the basic EPS? 0.0, 0.12. Which is number 1? So which has a least potential? Obviously, is this one, number 1. The number 2 is this. Then now, compute diluted EPS based on the ranks. So you mentioned about securities. You mentioned about earnings. You mentioned about shares. So that you get diluted EPS. So now we start from basic. So from basic EPS, our earnings pulse was 14.558. And this one was 0.042. 0.08. This is 1.75. So here we have 13.37. So the first one was convertible. The one which has a least potential in diluting this 13.34 is convertible loan stock. Earnings is 0.67. This one is 5.75. You add 14.558 plus 0.67. This is 15.228. 1.0875 plus 5.75. This is 6.8375. Divide this and this. 15.228 divide answer. 2 points. Is it 2 or I have made a mistake? It's 2 points, or because it has reduced drastically. It's 2, eh? This was diluting it at a high speed. So 2 point, 2.23. Then the next one was convertible preference. Because that is number 2. So its earnings is 0.042, 0.14. So 15.228 plus 0.042. So this is 15.6. 6.8375 plus 0.14. So 6.9775. 15.6 divided by answer. So this is this is 2 points. This total is okay. Because it's 15 plus, that is 15.228 plus 0.042. So this is 15.27. This one is okay. So you divide 6.9775. So yes, you get 2.19. So we can conclude that diluted EPS is equal to what? This one is the one which has been diluted by the N. It has been diluted drastically. So shillings, so diluted EPS is equals to shillings 2.19 per share. That is the end of the session today and end of this question. So that is how you were supposed to do this question. This is how you are supposed to do this question. Are we together, students? Some of you left, wengine wamechoka wakatoka njiani. Ma question imekuwa ngumu. Diana, how are you? Yeah, so We can go to the session for today. We stop at this point. When we meet next time, it's now time for group accounting, whereby we will do group accounting for the questions of parent acquiring subsidiaries, associates, joint ventures, disposing them, acquiring them, and we do cash flow. I think for the students who joined from day one, that would be like your last topic, which is important for this semester. Are we together? The rights of Christine, the rights of Christine, the rights of